Self-directed IRAs. I like self-directed IRAs. You like self-directed IRAs?
If they're used the right way.
Absolutely.
I see them get abused a lot because we put the wrong kinds of assets in them.
Right. And you can break up those transactions really quickly.
Yeah.
You know, they are tax advantageous. They give you a little more flexibility. If you're one of those individuals that is just kind of sour on the stock market, right? And you think that you can invest in real estate or precious metals or dealing in private equity, commodities, things like that, and you can get a better return on your investment, you want to be actively participating in that. I encourage you to do that. You got to run through a third-party custodian to do those things. You know, there's some, as Rick alluded to, there are some fees and management costs that's associated, as well as there are some busted transactions. I know the first one comes to my mind because what I see most of the time is real estate is what these are.
That was exactly what I was thinking. Is
okay.
People put real estate property in there and they think I'm perfect. I'm going to get to take this money, put it into a property, and I'm going to get all this tax-free money on it. And I'll be honest, I am a huge opponent of putting real estate into SDIRAs. And the reason why is an SDIRA, which means you've lost the biggest deduction out there, the biggest reason to have real estate. Right?
Yep.
And here's the other thing. When you sell that real estate inside that SDIRA, it's not a capital gain.
No, it's not. It's not.
So if you're a high net worth income producer, you want capital gains because they're taxed lower than what you're getting.
Yeah.
Okay. And so you've just avoided the benefit of having real estate property because now you've just sold it and now it's ordinary income.
Yeah.
So when you take that money out, it's taxed at your ordinary income rate. It's not the capital gains rate.
It is. Very true, Rick. Very true. You know, you can't have any, one of the things that I always see get busted up is you can't have any encumbrances.
Yeah.
Right. So
no loans.
You can't have any loans on this deal. You know, you can have, let's just say you find a piece of real estate and that real estate, let's just use a round number of $100,000 and you only have $20,000. Now you can pool your $20,000 with 5 other investors or whatever, 4 other investors and y'all can all buy that. But the key element is you can't have any debt that's associated with that. It will bust the transaction.
Yeah.
Also, you can't sell it to yourself. You can't sell it to a family member, things like that.
You also can't use it yourself. I see that a lot.
Absolutely.
I'm going to buy my own house and it's going to be owned by my IRA. I'm going to live in it.
No, busted that transaction.
No, because what these transactions are designed for is that you can have no benefit personally from them, right? It's the same thing with people that try to start companies with an SDIRA and they think I'm going to invest my IRA money into my company and I'll just pull it all out myself. No, you cannot have you cannot personally benefit from the transaction at all.
You cannot. And so you got to be very careful. Once again, there are specific IRS regulations that are associated with this. As we always say, make sure you sit down with a trusted advisor to make sure you're in compliance, because if not, you are going to bust those transactions. And when you bust those transactions, you're going to have a lot of taxes and penalties that's going to be associated with that, guys. So without going into all those details, some of the things we did talk about was borrowing money, selling assets to yourself or a disqualified person, and providing services to the SDIRA as well. Look, there's a lot here. We've got so much to continue to cover, but if you want to sit down with Rick or myself and learn more about SDIRAs, there are a benefit for them, but let us help guide you through that. Okay.